Hello, everyone. I'm Ken Leon, Director of Equity Research at CFRA, and we're excited to have today's webinar as part of The Road to Recovery, Invest in American Infrastructure, Opportunities, Risk, and Politics. Next. Joining me today are our experts covering the industrial sector, Elizabeth Vermillion, Matt Miller, and Richard Wolf. We're really excited to really go after this topic, especially because of the opportunity we see in terms of large spending from government and perhaps the private sector. Next. Today's agenda will certainly give those who are not familiar with CFRA who we are. We're going to cover really what is infrastructure, and then dive deeper into some of the leading industries of construction, machinery, and engineering, materials and steel, HVAC and elevators, and then open it up for Q&A. Next. CFRA today is one of the world's largest independent research firms with over 75 professional analysts. We have a long tradition. The franchise was always well known in terms of its forensic accounting, world-class, and then in October of 2016, adding the S&P equity and fund research. Additional acquisitions have really made us more robust and relevant for the markets, acquiring First Bridge Data, which brought data and analytics for ETF. And the innovation has been incredible across our organization for equities, ETFs, and funds. Next. So the proprietary methodology engine, or what I call the flywheel, is our ability to take our research IQ and its fundamental research and leverage it across our perspectives from top-down market commentary, regularly on webinars with Sam Stovall, Chief Investment Strategist, sector and industry research, and that's the collaboration that Sam and the Investment Policy Committee has with the sector and industry analysts. Todd Rosenbluth heads up our ETF and mutual fund research, another thought leader that's often on CFRA webinars. And then our foundation or base, which really is our coverage of 1,500 qualitative companies on a global basis. We also have a quantitative platform which gives you scale to 25,000 global companies. But it's really the how-to or the why of CFRA's excellence with diagnostics on industry and company monitoring, risk mitigation, and the fundamental analysts, as we have on today, leverage that from the forensic team. What I'm most proud from the fundamental research team is every week we are sharing thematic research, which is our investigative insights on industries and coming with positive or negative implications for key companies. Worthwhile to check thematic research on MarketScope Advisor. Next. So it's one thing to have robust, large-scale coverage, great research, but it's important that we provide recommendations that are actionable for our clients. For those firms covering more than 900 stocks, we ranked #1 in terms of our combined buy-sell performance. And generally, we are in the top 3 or 5 over time. CFRA clearly tries to look for opportunities, not just long and hold, but also sell ideas. In many cases, this is to help our clients look more seriously at holdings that might be at risk. Next. Let me finish up and just talk what I think is most important, what I'm most proud about being part of CFRA is our independence. This is all we do. 100% of all our resources, whether it's human or financial capital, are invested in fundamental research. And that speaks to not only the research analysts, but the great teams that we have in terms of development, in terms of technology, marketing, sales. I'm really excited where CFRA is today. and we continue to be looking to invest and innovate. And mostly, we're not a broker-dealer. We do not have any asset management capability. We're here to provide advice to our customers. And while some of our competitors claim to have these offerings, they really aren't. So with that, let's move to the next slide. And let me introduce Elizabeth to speak about the introduction to infrastructure. Good morning, Elizabeth.
Good morning, Ken. Thank you. So we're going to start broadly with a quick review of U.S. infrastructure, and then I will discuss infrastructure related to construction machinery and engineering. And then I'll pass it over to Matt for construction materials, and then Richard will wrap up with a review of HVAC and elevator, and then we will open it up for questions. So what is infrastructure and how do we define its scope? Infrastructure is the foundation that connects U.S. businesses and enables communities to thrive. So it includes roads, water systems, the energy grid, and all of these things help drive the economy and support the overall quality of life by ensuring public health and safety. A well-functioning and modern infrastructure system is really essential to economic development. Some of the major infrastructure categories that we look at are transportation, so that includes roads, bridges, and airports, communication, water and sewage, so that includes the support of safe drinking water and wastewater facilities, utilities, and electric systems. So now moving on to the current state of U.S. infrastructure. On the next slide, the story of U.S. infrastructure is really one of decades of underfunding. So on the slide here, you see a scorecard published every 4 years by the American Society of Civil Engineers. So this is the most recent report, and it's from 2017, so a new update is coming soon. And so this current scorecard really highlights the dire state of American infrastructure. The cumulative overall score is a D+, and this is same score, it's unchanged from the 2013 report card. So it's very clear that U.S. infrastructure is in very poor condition. In 2019, the U.S. spent just 2.5% of our total GDP on infrastructure. Still on that last slide, Cassie. We are poised to underinvest our infrastructure by $2 trillion between 2016 and 2025. So that comes down to $206 billion of underinvestment per year. So it's pretty easy to assume that the longer we have this funding gap for aging infrastructure, the more costly it's going to be to refurbish. So failing to close this infrastructure investment gap really does have serious consequences. The ASCE estimates that by 2025, it could surmount to $3.9 trillion in losses of US GDP and also 2.5 million American jobs. So now looking at some of the headwinds for US infrastructure from COVID-19. COVID-19 has really impacted different infrastructure classes in a myriad of ways. So we're going to take a look at some investment classes that are a little bit less sensitive to headwinds. So utilities, though they're not immune to the effects of sudden deterioration from economic activity, they are generally well positioned to cope with these short-term demand shocks. So that includes COVID-19. A well-run utility does typically earn a fair return on invested capital, and it recovers all of its costs, including its debt service. And this is thanks to the prevalence of cost of service rate making and a durable regulatory framework. The power sector is slightly more sensitive to COVID-19. So a perfect storm for a significant tumble in power prices has occurred this year. So that includes the recession, lower commodity prices, lower carbon prices, and extremely mild weather. So in the US, the EIA is forecasting about a 5.7% decline in electricity consumption in 2020 versus 2019. So this is really, and there's also additional risk for these energy suppliers as it relates to delayed payments of energy bills from their more vulnerable customers. And in a lot of cases, this is actually government mandated. We see more significant sensitivity within toll roads and oil and gas midstream. So these government enforced lockdowns have led to significant declines in traffic levels Globally, traffic levels have been down 40 to 85%, depending on the nature of the road and the scale of the containment measures in that region. So toll road traffic is expected to decline by about 15 to 25% in 2020. And we really do think that as the lockdowns open back up and as people get more comfortable, road traffic will recover quickly, especially once people begin to resume daily commutes in larger numbers. And then to wrap up here, the hardest hit infrastructure class is airports. The IATA expects global passenger traffic in 2020 to be roughly half of what it was last year. And these travel restrictions have really brought passenger services to essentially a standstill as of the second quarter. Right now, forecasts are for a 3 to 5 year recovery to get to pre-pandemic levels, and that's a relatively optimistic forecast. So now I'm going to move on to discuss the role of construction machinery and engineering companies within the industrial framework. So most infrastructure needs are severely underfunded. The chart on the slide here demonstrates, it shows funding that is both public and private. And we would really like to stress that the underlying demand for infrastructure is there. There's no questions there. It is the demand is high, but the funding is where we're lacking. And really, a federal infrastructure bill is one of the only options for this unfunded gap to be closed. While the US does have some of the most resilient infrastructure systems in the world, conditions have deteriorated over time as this infrastructure has aged. So the infrastructure in the US right now was built in line with guidelines for roughly 50 years ago. And so, of course, over time, these have become inadequate as just regular wear and tear has worn out the infrastructure and due to more frequent extreme weather events that we see today. Some states have stepped in to counter these investment shortfalls. As of right now, about 31 states have raised their gas tax rates, or have some kind of state legislation that allows for indexing of gas tax. So this state action, coupled with some federal funding levels, has slowed the downward trend in highway spending. So the federal contributions are lower there, but it still is below the level required for efficient operating of a highway system. So it's cases like this that are pretty common across all of these different categories seen here. So now looking a little bit deeper into the balance in between state and local and federal infrastructure spending. So the US has hovered around 2.5% of GDP spend for US infrastructure over the last few decades. So this means that even as our economy is growing, the federal spending is not really keeping up. And so as you can see here, the majority of the funding in the last 15 plus years really has been from state and local governments. There was a slight increase in federal spending in 2009 and 2010 following the Great Recession, but that really did taper off as states and localities improved their fiscal health following the recession and recovery took hold. The federal spending trickled off. And so while, when you think of infrastructure spending, a lot of people do think of federal infrastructure spending. That's what gains the most headlines. But states and localities have long been in the driver's seat and are contributing over 90% of all non-defense public infrastructure spending in the current operating environment. So looking a little bit more at what goes on in federal infrastructure spending. So infrastructure spending really has a long held an appeal for lawmakers as a way to spur growth, as you could see on the last slide after the Great Recession. And so this pandemic that we're in right now is renewing calls to fast track roads and other projects, even though we think it's probably too close to the election period now for any large build or spending plan to be passed. Federal infrastructure spending has been a pillar of the Republican platform in the 2016 election and in the current campaign, and it is generally woven into the other core priorities that they run on. So right now you're seeing infrastructure spending woven into some priorities such as bringing back manufacturing jobs from abroad and 5G development. So even though this was such a huge focus for the 2016 election, no bill was passed during the 4 following years. And we really do think that the optimal time for a large infrastructure spending plan would have been in the year immediately following the election. So this year, the platform is relatively unchanged, and we do expect an acceleration about the rhetoric for infrastructure spending as we get closer and closer to the election, but it's unlikely that a large bill will be pushed through in 2020. The Democratic Party also kind of nestles infrastructure spending into some of the other core priorities of the platform. And in this case, the spending is mostly concentrated in the package that is geared at fighting climate change. So overall, we don't think that a large federal spending plan is a given under either party, though it is something that is going to be widely discussed. And so we do think that, in the near term, infrastructure is going to continue to deteriorate. So within infrastructure, we can look at construction spending in 2 main categories, and those are residential and commercial, also called non-residential. So commercial construction is about 60% of the total construction spend, and it is building for commercial purposes. So that includes stores, offices, schools, airports, infrastructure facilities. And then residential construction, which is about 40% of the total spend, is more specific to homes, condominiums, and townhomes. In 2020, CFRA forecasts that total construction spending will decline 3.2%, and the largest contribution to this decline is in non-residential, which we forecast to be down about 7.5%. In 2021, we expect total construction spend to improve about 2.2% as recovery really does start to take hold early in the year. This economic downturn is unprecedented, and so we do think that a comparison to the Great Recession in 2008-2009 is rather misguided. So in the Great Recession, it was a global credit crisis, and it included a housing price bubble and then a resulting price decline that led to a liquidity crisis. So at that time, counterparty risk and insolvency risk were major drivers of the downturn. So that recession hit residential construction much harder than non-residential construction spending. In the current recession, as a result of the pandemic led to widespread shutdowns or slowdowns across so many sectors of the economy. And overall, these shutdowns have been more detrimental to the commercial side of construction rather than the non-residential side, or rather than the residential side. Residential side has really remained rather resilient and is supporting, keeping declines from being more severe than they are. So we do expect a very different response in construction spending in 2020 and 21 as compared with the response of global construction spending in 08 and 09. So taking a look into some further COVID impacts for infrastructure and construction, there are a number of areas where there have been some very significant headwinds, but there are also areas that have remained strong through the pandemic and that are already on the road to recovery. So in some areas where we see the greatest headwinds are just the uncertainty across the supply chain. The pandemic has really accentuated the uncertainty that is plaguing customers, suppliers, Capex spending across the supply chain. And a lot of this uncertainty was already in place pre-pandemic due to widespread industrial softness, tariffs, and the trade wars. So the pandemic just added on top of that. Demand in some end markets through the pandemic has bottomed all the way to 0 or almost 0. And then there's also been limited access for service and replacement. And service and replacement is often a more resilient part of an infrastructure and manufacturing market in a downturn. So this is a unique aspect of this recession as well. And then also we point out that share purchases across the industry have been paused, and in most cases we do not expect share repurchases to resume until 2021. Some areas where we have seen strength through the pandemic include e-commerce, and that's both to residential homes and increasing utilization from commercial facets. Home centers and DIY projects have been very strong. Demand has been very high there. Life sciences and safety projects where understandably demand has been well above average. Construction projects that were already in the works have continued with few to no interruptions. And then dividends across the industrial names that we cover have been fairly stable, with minimal cuts and in some cases even increased dividends. And we see many construction machinery companies posting sequential monthly improvement through Q2 and early Q3. And this really supports our belief that demand is slowly but surely recovering across the industry. We're seeing increased efforts from a lot of the companies to improve their technology integration, automation, and smart connectivity. And the downtime that they've faced from shutdowns and social distancing has really enabled them to put more time into working through this smart connectivity, which is going to pay off in the very near future. So looking into the conservative CapEx environment a little bit more, CapEx spending has been extremely conservative through this year, which we believe is a direct result of the elevated uncertainty from COVID-19. So this uncertainty is high across the entire supply chain, from suppliers to end customers. So on the slide here, you can see highlighted in orange CapEx spending quarterly in the Great Recession, as well as so far this year. And right now, CapEx has been weaker on average than it was through the Great Recession, but we do look for CapEx to rebound in the near future as soon as demand begins to improve and recovery really takes hold and some of that uncertainty is relieved. That will really spur companies to be more comfortable with larger CapEx spends. Right now, the worst case scenario for CapEx recovery would be L-shaped recovery. And of course, the best case is a V-shaped recovery. So within construction machinery, some projects are definitely performing much better than others through the pandemic. Some of the best performers include technology solutions, work with government contracts, and utilities. And so these projects are characterized by having strong demand and the fewest interruptions from shutdowns and social distancing. Some average performers are short cycle projects and electric infrastructure. Overall, these kinds of projects have faced more manageable headwinds from COVID-19, but have been marked by more softness in the near term in their demand. And we do expect recovery in these projects in the next few quarters. And then the weakest performing projects faced soft demand prior to COVID-19, and headwinds have just kind of added up as different issues have come up with the pandemic and social distancing and shutdowns. We consider midstream pipeline and anything automotive related to fall into this category of weak before COVID-19 and really taking a step down through the pandemic. And then finally, taking a look at the impact of urbanization and population trends on infrastructure spending. So the urbanization trend in the US is a lot more mature than it is in other parts of the world. Right now, about 82% of the US population lives in urban areas. And this really stresses the importance of updating infrastructure. Urbanization is really driving the need for improved transportation and building infrastructure. This is where a lot of the infrastructure is nearing or well past the end of its recommended life. So if you look back at that ASC scorecard that we highlighted earlier, and then a few highlights here, so you can see that roads and airports and water infrastructure have a grade of a D, and rail is the worst performing category right now at a D-. All of these categories are vital for supporting rising population, and that's whether it is in an urban or a rural area. Something that people are discussing right now is if COVID-19 could lead to a shift out of these dense urban areas into more suburban areas. And we don't think that this causes any change in the need for infrastructure improvements. It might shift which projects are in a priority. But overall, we feel that no matter where population shifts, the same total level of spending is required to whether it's to update in urban areas or to build out in more rural areas. And then so to wrap up, I'm going to go over some near-term actionable ideas that we have in construction machinery and engineering space. So we have a buy on Caterpillar, supported by our outlook for benefits for a better balance between their production levels and demand levels and the demand in the supply chain. So they've really improved that, and it's going to set them up to be able to capitalize on rising construction spending that we forecast in 2021. We have a cell on Illinois Toolworks reflecting our expectation that their diverse end markets are really going to face very soft near-term demand, and we don't see many near-term catalysts that is going to spur growth. We have a buy on Jacobs Engineering, and this reflects our view that their work with the government is going to support much more stable demand than many of their peers, and who have less exposure to some of these long-term contracts. Quanta Services, another construction engineering company, is supported by 5G infrastructure build-out in the more medium and long term, and then in the near term, their utility work for grid modernization that is required in the Western United States and in rural areas especially. And then finally, United Rentals. We believe that they have a very strong market position, and we expect rapid recovery in rental revenues as these construction markets open up and project work continues to accelerate. So with that, I'm going to pass it over to Matt.
Yeah, thank you, Elizabeth, and good morning, everyone. Let's now shift gears a little bit and look at a different part of the supply chain and focus on the materials that are the building blocks of nearly every infrastructure project, which are construction materials and steel. We highlight these two sub-industries as major beneficiaries of higher construction and infrastructure spending. Yes, both of these sub-industries do have significant leverage to infrastructure spending, but the fundamentals that are driving them are quite different. Construction materials companies have actually performed extremely well throughout the COVID-19 pandemic as construction projects have continued and deemed essential in almost every state. Steel producers, on the other hand, have suffered from really the automotive and heavy equipment OEMs shutting down operations. And the construction materials company's most important product is aggregates, which is crushed stone, sand, and gravel. And because of the high weight to value ratio, these products typically are produced within a tight radius of where they are ultimately consumed. And this fact, really combined with the fact that there's enhanced regulations on new stone quarries, has really given the industry a wide economic moat and allowed the industry a great degree of pricing power. Now, steel, on the other hand, is a global market, and cheap steel products have flooded the US market for decades. The Section 232 tariffs and quotas have helped reduce the imports and temporarily improve the fundamentals, and this has led to steel producers in the US pursuing major capital programs to invest in new capacity. And this is happening maybe at the worst possible time now with 2020 vision on that. On slide 24, we highlight the highway spending is really what moves the needle for construction materials companies. As I mentioned, aggregates, which is crushed stone, gravel, and sand, is the most important product for these companies. And the most aggregates intensive public works projects relate to surface transportation, and that's roads and bridges. As Elizabeth showed earlier, when she was highlighting US infrastructure needs, both funded and unfunded, the surface transportation was at the top of the chart and could be one of the biggest beneficiaries of an infrastructure bill. Surface transportation accounted for 1.1 trillion of the funding gap, or 53% of the total. And therefore, any major infrastructure package, whether Democratic or Republican, would likely have more meaningful spending dedicated to roads and bridges, which would be a positive catalyst for aggregates demand and construction materials companies in our view. The long-term growth and demand for aggregates is largely driven by growth in population, jobs, and households. And while short-term and medium-term demand for aggregates can fluctuate with economic cycles, the declines have historically been followed by strong recoveries, with each peak establishing a new historical high. And the drivers underpinning the demand recovery and really a sustained multi-year volume and pricing growth in this industry remain firmly in place in both the public and private sectors of the economy. And these include things like population growth, continuing increase in household formations, continuing increase in transportation funding at state and local levels, and increasing political awareness or acceptance of the need to invest in infrastructure. On the next slide, we highlight the public versus private consumption of aggregates. And CFRA thinks public construction is going to be a long-term secular tailwind for this sub-industry, that is the construction materials sub-industry. Although both public and private construction spending are important for these companies, public infrastructure spending, as you can see, is generally more aggregates intensive and it tends to be much more stable. And this is because of the predictability of the funding from federal, state, and local governments. And therefore, growth from public construction is more desirable than private construction. A higher level of commitment from governments to invest in fixing our roads, bridges, and other infrastructure is going to lead to strong and stable earnings growth for construction materials companies in our view. Now on slide 26, we highlight what the biggest hurdle to more infrastructure spending has been and continues to be, and that is an old and outdated system to fund the Highway Trust Fund, which as a result, this has led to major insolvency issues for more than 15 years. The trust fund gets its revenue from fuel excise taxes, which have not been increased since 1993. And with the impact of inflation, the purchasing power of that tax is about 45% less than it was in 93. And what is making matters worse for funding roads is that electric vehicles and hybrids are increasing in use, and the tax of the future will likely need to focus on miles driven each year rather than a fuel tax at the pump. Now, since the Highway Trust Fund cannot fully fund projects, the federal government has needed bills to authorize spending from the Treasury's general fund. This is referred to as a highway bill, and the most recent one is called the Fixing America's Surface Transportation Act, or FAST Act. Now, these spending authorizations are typically 5 years, and that long-term nature allows state and local DOTs, Department of Transportation, to budget for larger, more complex projects. So it's extremely important. On slide 27, this really emphasizes the importance of highway funding at all levels of government. A state's Department of Transportation are ultimately responsible for planning and coordinating the federal highway and transit investments. And each year they prepare both long range, which is a 20-year, and a short range, 4 to 5 year plans, outlining how they intend to use those federal funds. Federal highway programs are dedicated almost entirely to capital projects rather than to the operation and maintenance of roads. And we use 2017 as an example here, showing that 96% of the federal spending for highways went to capital investment. And such an allocation between this capital versus maintenance has been typical for spending on highways since the 1950s. Because the federal government does not generally own the highways, the responsibility to operate and maintain them falls to the state and local governments. And you can see that states, the spending pattern for states account for more than 60% when you're looking at maintenance net of federal grants. And this is the case going back also for several decades. This has been the trend. Now, the importance of the federal grant system is that every dollar of new capital is matched at the state level, which creates a multiplying effect of any federal stimulus for infrastructure. Now, on the next slide, slide 28, we show the current highway authorization bill, referred to as the FAST Act. It has been a significant contributor to higher public construction spending in the last 5 years. And while the FAST Act was a substantial 10% increase in highway funding compared to the preceding funding bill, both the Senate and the House proposal have funding proposals much higher than the FAST Act, from 27% to 42% higher. We think this is a strong sign that politicians are starting to really understand the importance of infrastructure and the dire state of repair. The FAST Act expires at the end of September, and it is increasingly unlikely that either party would give the other a victory this close to the general election. So therefore, a large stimulus package is likely going to have to wait until after the November election. The most likely solution is a continuing resolution as a stopgap until a new 5-year highway bill can get passed after the general election. A continuing resolution is not great news for this industry, but between the last bill, which was the MAP 21, and the FAST Act, there were 13 continuing resolutions, which typically get done at or above the current spending levels. Now, after the general election, we expect infrastructure will be headed higher with the 5-year authorization bill likely in 2021, given bipartisan support. On slide 29, we look at state and local governments. States have increasingly been taking on a larger role at funding roads and bridges, and since 2012, 32 states have increased or adjusted taxes on motor fuel. In 2019, in the November 5 election, voters in 19 states overwhelmingly supported transportation investment, and they approved nearly 90% of the 305 state and local transportation ballot measures. So there's widespread support amongst constituents on infrastructure spending. On slide 30, we show our best ideas in construction materials. Both Eagle Materials and Martin Marietta Materials have 4 stars or buy ratings, and Summit is a 5 stars or strong buy. Eagle Materials is looking to split off its light materials or its gypsum wallboard segment and its oil and gas frac sand business, which in our view should unlock shareholder value. Summit Materials, it trades at a discount to its peers, and we forecast top-tier growth rates. And this really justifies our 5-star recommendation on that equity. We're going to move on to the steel market, and you can see on the slide the steel consumption by market. I wanted to point out that non-residential construction is in fact the largest in market at around 44% of consumption. But if you add in machinery and equipment accounting for 9%, the impact of higher infrastructure stimulus would benefit around 53% of steel consumption, a very important potential positive catalyst. But it's also important to note that automotive OEMs rebounding is equally important. One of the largely unanticipated consequences of COVID-19 is how strong the demand for automobiles has been. And this could be attributed to commuters wanting to avoid public transportation as much as possible. On slide 32, we show how much COVID-19 has impacted capacity utilization. This is domestic capacity utilization of the steel industry in the US, and it quickly reached levels hit during the Great Recession. The steel industry needs to get utilization back above 80%, which will likely require both major infrastructure stimulus as well as automotive OEMs firing on all cylinders. And one last thing, of course, is continued protection from Section 232 tariffs. Now, not all steel companies are created equal, and on slide 33, we show the supply chain for steel. COVID-19 initially led to weak iron ore and steel prices. However, iron ore prices have bounced back very strong and have been trading around 2-year highs, given supply constraints in key regions. Now, iron ore producers have a strong outlook in 2021, in our view, as a result of these high prices. When we distinguish between integrated mills and mini mills, the biggest difference is that integrated mills use iron ore as an input into a blast furnace versus mini mills using recycled steel in an electric arc furnace. The distinction is important because their fundamentals are quite different. The integrated mills are facing higher legacy liabilities and are less flexible when it comes to being able to adjust its cost structure quickly as demand changes. The companies that are best positioned to win today and in the future, in our view, are the mini mills, such as Commercial Metals Company, Steel Dynamics, and Nucor. On slide 34, we show our actionable ideas in steel. We have a strong buy opinion on Cleveland-Cliffs, which is really driven by its improved financial position, its competitive advantage in delivering iron ore pellets, and an important new capital project, and that is its new facility in Toledo, Ohio, which is going to allow Cleveland-Cliffs to start serving iron ore feedstock to the electric arc furnaces or the mini mills, as well as integrated mills. On the other end of the spectrum, we have a strong sell recommendation on US Steel. We see significant balance sheet and liquidity risk here. And so for that reason, we highlight US Steel as a major risk in this environment. And so that concludes our discussion on construction materials and steel. I'll now hand it over to Richard Wolf.
Thank you. Good morning. As Matt said, we'll focus on heating, ventilation, and air conditioning, commonly known as HVAC, and elevators. First, we'll start with residential HVAC. We're still in the middle of a strong replacement cycle, which provides predictable revenue in times of uncertainty. The graph in the middle of the slide reflects housing starts, which are new residential construction projects reported every month. We can see they peaked in 2006, and because most houses come with an HVAC unit with an average life of 15 years, we think 2020 and 2021 are strong replacement years. Despite being in a recession, which usually results in a shift to parts and repair, we see some positive indicators for keeping this replacement cycle stable. People are facing the heat head-on as they work from home more. And as we can see from the graph on the right, cooling degree days are up from 2019 levels, meaning it is getting hotter. We also see trends as people are spending less on travel and entertainment and redirecting that money into home investments. On the next slide, we will show that management commentary also supports the replacement market. Both Lennox and Carrier indicated during their Q2 earnings calls that replacement demand is maintaining its strength over parts and repair. This is favorable for the HVAC companies, as most residential exposure is replacement demand. As we can see from the chart in the middle, that is not to say that new construction will lag too far behind. Our expectation for increased residential construction spending bodes well for the other 25% of the residential breakdown. Going forward, we believe a strong residential market will help drive sequential month-to-month growth and ultimately reflect favorable Q3 results. Another indicator that supports this observation is the slowdown in air conditioning shipments in April amid the height of the pandemic, followed by increased shipments in May and June. Next slide. Next, we'll talk about non-residential HVAC. We think those with more non-residential exposure in the U.S. will be able to benefit from COVID-19 opportunities as well as infrastructure-related and energy-efficient opportunities. As we can see here, based on our estimates, Lennox's HVAC portfolio has the most residential exposure, and Johnson Controls has the most commercial exposure. Carrier and Trane fall somewhere in the middle. We note that not all commercial HVACs are the same. Carrier and Lennox's commercial exposure is more focused on unitary and light commercial units, which are generally simplistic and can lose service revenue to third-party companies. Trane and Johnson Controls lead the applied markets, which are more complex and come with more service revenue for those companies. Next slide. So the first opportunity we'll talk about is COVID-19 and returning to work and school. So not everybody will be returning back to work or school at the same time. As of August 24th, 39 states are leaving whether or not children will be in the classroom to district-level decision makers. Between now and when people return to work and school, our view is that commercial and institutional spaces will make investments to enhance indoor air quality regardless of its occupancy rate. The American Society of Heating, Refrigerating, and Air Conditioning Engineers, or ASHRAE, has come out with recommendations and strategies for reopening schools and building readiness. HVAC strategies include increased ventilation, improved filtration, and air cleaning devices. We break these strategies into 3 opportunity groups: retrofitting, supplemental, and services. So when looking at retrofitting, ASHRAE recommends using a minimum efficiency reporting value, or MERV 13 filter. So the higher the air filter efficiency, the better protected the occupants inside the building will be. However, with a high filter comes reduced airflow, which, if not properly retrofitted for, could lead to a stressed HVAC system, including a blown fan motor and more service needs. Other opportunities include adding an economizer, which gauges outdoor air temperature and humidity levels, and at the right level, brings in fresh air and enhances indoor air quality. An example of supplemental devices is Carrier's OptiClean air purifier, which can be used as an air scrubber or negative air machine. So using portable room cleaners like this can help for buildings and schools with HVAC systems that can't support a MERV 13 filter, as these systems generally have filters with high MERV ratings. In late August, Carrier won a contract to supply a California school district with this system. And going forward, we expect similar contracts for portable room cleaners, especially in older buildings or in areas where higher filtration is needed, like health facilities. Another example of a supplemental product is the installation of ultraviolet or UV devices, which can be used to disrupt bacteria, fungi, and viruses on surfaces and airstreams to supplement ventilation and filtration. Lastly, we think service demand will increase. The first step will be for school districts or large office buildings to get an indoor air quality assessment to determine what changes they have to make. ASHRAE's recommendation to run the HVAC more than usual, whether to increase ventilation or flush the system of any particles after building hours, will also drive service demand in our view. Next slide, please. The next opportunity we will talk about is the secular shift to energy efficiency. Going back to Elizabeth's key differences between Trump and Biden's infrastructure plans, Biden has a strong outlook on climate change, including a target of cutting the carbon footprint of the U.S. building stock in half by 2035 and setting new net zero emission standards for all new commercial buildings by 2030. Buildings account for 40% of all U.S. energy use, and HVAC is a major area of energy consumption, about 40 to 60% of that energy use. Whether it is the investment in a whole new HVAC system or making some retrofits, so adding economizers, sensors, and solutions that better measure airflow, we think there are opportunities here. We note that some companies were making improvements regardless, though. In 2019, Johnson Controls conducted a survey that indicated 67% of companies were going to invest in HVAC improvements and building controls improvements in 2020. However, we think with government support or that government support would accelerate growth in these areas. The shift to energy efficiency doesn't come without headwinds. The Department of Energy establishes minimum efficiency standards, and we believe changes will bring increased research and development expenses and capital expenditures so HVAC companies can refresh their products and bring climate sustainable solutions to market. Examples include higher seasonal energy efficiency ratio rated systems, as well as lower global warming potential refrigerants. Next slide. So let's look at results from the last recession. So from the chart on the left, we can see that out of the home improvement expenditures for systems and appliances during the last downturn, HVAC performed the best on the way down and strongest on the way back up. HVAC repair and replace is a non-discretionary spend compared to a lot of systems and appliances that would be more in line with renovations or modernization efforts. As we can see from the graph on the right, year-over-year sales growth bottomed out in early 2009 before finding stable ground in 2010. Next slide. So where are we now? As expected, residential is holding up better than commercial, and within commercial, applied systems, which have more service opportunities, are faring better than unitary systems. We think Q2 2020 marks the bottom, and that the opportunities we spoke of in previous slides will start to materialize over the next few quarters. This, coupled with strong residential replacement demand that we think will continue in 2021, reflects a V-shaped recovery in sales growth, as we can see from the graph on the right, where we estimate by Q2 2021, sales growth for all of the HVAC companies will be at roughly 12% year over year. Next slide, please. Lastly, we will discuss the elevator industry. So we think elevators are in a favorable position during the downturn, given that most of its profits derive from service contracts and that infrastructure and COVID-19 related opportunities do exist. With new construction comes new service, as conversion rates in this industry are generally high, between 70 and 80%. Some of the COVID-19 related opportunities include social distancing modernization, touchless technologies, including using a smartphone to call an elevator or hand-foot gesturing technology, purification fans, UV light systems, which would clean cabin surfaces, and cheaper options, such as antibacterial film to cover floor and cabin buttons. We also know that more than 50% of end market exposure leans towards residential buildings, which we think will likely see an uptick in service requirements as elevator capacities are limited. Lastly, we note that Otis appears undervalued relative to its peers. We think that is because after spinning off from its former parent, Otis accrued a lot of debt. So now it has a net debt to EBITDA ratio of 2.2, while peers have negative net debt. However, given the low capital intensity of the elevator industry, we expect free cash flow generation to be robust and for Otis to reduce its leverage, eventually pulling up valuation, we think. Next slide. So which companies offer the most upside? We just covered Otis on a valuation basis relative to its peers. And for HVAC, we believe the predictability of a strong replacement cycle is mostly captured by market expectations. So we think the companies with solid commercial exposure and ability to take advantage of COVID-19 opportunities and energy efficiency opportunities will provide the best returns. So we have buys across 3 of the 4 pure play HVAC companies, being Carrier, Johnson Controls, and Trane Technologies. At this time, I'll turn it back over to Ken.
Thanks, Richard. And now looking at Q&A, if you do have questions, feel free to send them in via chat and we'll get to them. A few have already come in. The first one for Elizabeth is, there was quite a bit in terms of funding. And the question is whether we could see private funding perhaps fill the gap when government funding might be shortchanged because of lower tax revenue, with a recession and COVID. What do you think of that?
Okay, yeah, thanks, Ken. So while we do think that private funding might be able to help narrow the gap, we currently don't believe that private funding is going to be able to replace a federal funding plan. There are a lot of challenges with sourcing just the sheer amount of funds needed. Sourcing those privately, there can be a lot more conflicts of interest. There's challenges because a lot of times the funding comes from a group of private investors. So there can be a lot of different conflicts with working with a group of different investment sources. And then the parties still do need to do a lot of work with governments for permitting and regulation. So in the end, private funding can definitely kind of get you a step in the right direction, but we don't believe that it's going to be able to fully close that unfunded gap where infrastructure will be able to take a step in the right direction and get up to date.
So Matt, staying on state and local governments, and you had a pretty bullish picture for aggregates, construction materials, and just thinking of the outlook, could we really see a recovery in 2021 from the standpoint of funding? And are there certain states or local governments that you want to be positioned with stocks? And I'm not sure if these are blue or red states, but every state is really being affected differently in terms of their budgets and tax base when you look across the country. What do you think?
Yeah, it's a really important question. Geography is critically important for the construction materials companies. I would say that, all of the publicly traded construction materials companies have purposely positioned themselves in some of the fastest growing regions in the United States. And there's mega regions where over the next 30 years, most of the population and economic growth are going to be in the US. And so, there's a lot of overlap. Like all four of the publicly traded construction materials companies that we cover have good exposure to Texas, which is forecast to be, the fastest growing state over the next 30 years, especially what is referred to as the Texas Triangle. And so that area is expected to grow quicker than other areas. And so all four have really good exposure to that region. And then you look at, and Texas, for example, has a very strong DOT. They've been raising their funding, so that DOT probably ranks as one of the best in the nation. And then you look at other key differences. Vulcan Materials has significant exposure to California, as well as Florida and Arizona. And California ranks very well as a DOT as well. Martin Marietta Materials is more, it gives you exposure to the Front Range of Colorado, also one of those mega regions where you're going to see a lot of population growth, the Front Range going from Denver all the way down to Santa Fe, New Mexico. And then you look at Eagle Materials, also has good footprints in California and Colorado. And whereas Summit Materials, in addition to large exposure to Texas, it's really a heartland producer. And what was interesting with Summit Materials, which is a name that we have a strong buy on, they performed very well because of that heartland exposure, which did not see as much of a COVID shutdown as other regions, such as the Sun Belt and the East Coast.
Great. Richard, two-part question here. First, HVAC and elevator opportunities. Do you think that these trends will diminish once COVID-19 is kind of arrested? And then we did have another elevator question on your thoughts of Dover. Ticker is DOV, and do you consider that as part of the elevator category, if you cover it or not?
Yeah, thanks for the question, Ken. So I don't cover DOV, actually. So I'm sorry, I can't really answer or speak to that. But for the first question, so I don't think the opportunities would really diminish completely. Like, so, if a vaccine comes out in the very near term, I think the psychological hurdles pertaining to COVID-19 will linger, and the fear of future outbreaks will remain for some period of time. So with that fear will come stricter building codes, regulations, and recommendations, resulting in different HVAC standards. And for elevators, I think it will be more fear-based relating to close quarters in general. So if there aren't building regulations that support safe distancing, even after a vaccine, I think people will take it upon themselves to catch the next one rather than hop in a packed elevator, increasing ride frequency and service demand overall.
Yeah. Elizabeth, you had a really interesting statement about that the U.S. country is over 80%, urbanized, and Is it really, urban markets, or is it metro? With COVID-19, we have seen households and businesses leave the city. So when you look at infrastructure, will we also see some kind of pivot here away from public transportation and downtown or urban markets to perhaps, back to highways again? What do you think here?
So I think that no matter where the population shift is or whether there's one or not, the long story short is that highways definitely need a significant amount of funding. Matt went over a fair amount of that in his portion. So whether or not there's a shift out of an urban area, highways are vital for getting things from facilities where they're manufactured, distributed across the country, whether it's to rural or urban areas. So highway, the need for highways is pretty much unchanged, whether or not there's a population shift. Within urban centers, the rail and the bridge infrastructure is pretty poor. So even if there were to be a shift out of cities, a lot of that infrastructure still does need to be updated. So a little bit less traffic burden on it would not really enable it to, that infrastructure to carry on for another few decades. It is to a point where it does need repairs. So maybe you could wait a few more years if traffic goes down, but again, it's not something that you could see a large delay in when that infrastructure repair or replacement was needed. And then in terms of if there were a shift to a more suburban or rural area, that would increase the road infrastructure, bridge infrastructure, potentially airport infrastructure needed in more of those areas where currently maybe just there isn't enough of it. So in that case, it's not as much repair and replace, but it's just a new build. So, as I mentioned a little bit earlier, the total spend probably won't change, but kind of where that spending is directed will depend on where the population moves. And it's really very early to tell if there will be a shift away from the urbanization movement. A lot of people are doing that temporarily now, but at this point, it's very hard to determine if that would be something that was actually long-term or if it's a bit more of a short to medium-term preference change, and then people kind of trickle back to their urban areas once the world goes back to a bit more normal of a cadence.
Right. So Matt, I want to play into your wheelhouse, covering materials, and you highlighted construction materials and steel, but when you think about infrastructure, what is the opportunity or benefit for aluminum and copper? Because I think over the last 5 years for investors, copper has always been looking to what's happening in China. Does this create a U.S. opportunity if there is a infrastructure bill?
Yeah, thanks for the question. Aluminum does not benefit as much as steel and copper from infrastructure spending. Aluminum really depends heavily on aerospace and transportation. And we think commercial aerospace may take several years before we get back to pre-COVID-19 levels. The outlook for aluminum is muted because aluminum can demand has actually been very strong with at-home consumption and pantry loading really driving this trend. So it's a mixed bag, I would say, for aluminum. Copper, much like steel, should see a meaningful positive catalyst from infrastructure in the U.S. However, as you mentioned, China is really what moves the needle for copper. China consumes more than half of the world's copper annually. But copper has seen a really strong rebound since March. It's now trading above $3 per pound on the back of Chinese infrastructure stimulus, actually, and supply constraints as well in key regions, especially Latin America, due to shutdowns related to COVID-19.
Richard, last question for you. Everybody on the call is pretty much working from home. We certainly probably are putting in more expensive filters for our air conditioning furnaces, but how do you think working from home will impact non-residential HVAC demand, and what does that mean?
Yeah, thanks for the question. So I think it really depends on the non-residential vertical. So pandemic-related closures and low building occupancy rates have had a negative impact on commercial HVAC services demand. So a long-term secular shift to working from home would likely have a negative impact on the office vertical. But I think it's important to keep in mind that the long-term work from home story isn't final, meaning there's a blend of perspectives surrounding the topic, making it truly uncertain whether employers want people in the office post-pandemic or if employees even want to be in the office. So additionally, the office vertical isn't the only non-residential piece. We think warehouses, data centers, health and education facilities should maintain some stability.
Great. Cassie, if we can go to the last slide, please. So on the road to recovery, we just want to give a shout out on the last of the 4 of our series, September 23. That will be the Real Estate Road to Recovery from the Abyss. We also have made available the previous Road to Recovery related to technology and healthcare, and they are on our platform. And then as we move closer to the election in October, we're going to be doing a CFRA webinar about the impact and implications for the equity market with Sam Stovall, Todd Rosenbluth, and Garrett Nelson to really speak about, particularly if it's a Biden win scenario, what it might mean for eco trends and electronic cars. Should be fascinating. Also, I want to reference to the new industry survey infrastructure that is also on Market Scope Advisor. For any more information that you need, certainly on the webinars, you can see the website to reach us, as well as to subscribe or expand the services you're getting on Market Scope Advisor as well. Mostly, I want to thank all of you for joining us today, and thank Elizabeth, Matt, and Richard for doing a terrific job on infrastructure. We hope whoever is elected in November, that finally parties in Congress can reach across the aisle and do something that would be good for America, which would be American infrastructure. So thank you again. Be safe out there and stay healthy. Take care.